So, you're thinking about upgrading from your HDB flat. It's a huge step, and you've got this massive decision to make. You have your savings, you're ready to go, but which condo do you actually buy? Do you go for the one that feels affordable and safe, or the one that's maybe a little bit more of a stretch? Today, we're going to unpack some of the hidden risks that, believe it or not, might just make that cheaper option the riskier one in the long run. Okay, let's just dive right into it. Picture this. You've got two condos in front of you. One seems comfortably within your budget. The other, well, it's a bit of a reach. Now your gut, your instinct, is to play it safe, right? Go for the cheaper one. But here's the twist. What if I told you that in the world of property, cheaper and safer are definitely not always the same thing? And really, that's the heart of the matter. I mean, there's a real sense of comfort in a smaller mortgage, a lower down payment. It just feels less risky, doesn't it? But what we're here to figure out is whether that feeling, that psychological comfort, actually lines up with the financial reality years down the road, especially when it's time for you to sell. All right, to make this really concrete, let's look at two super common scenarios for HDB upgraders. We're going to compare a condo in the $1.4 million range against another one at about $1.8 million. That $400,000 difference, that's where this whole story really gets interesting. So here's the quick breakdown. On one side, you've got the $1.4 million condo. Let's call this the safe stretch. It feels affordable, no doubt. But the catch? You are jumping into a pool with a ton of competition, a huge number of similar properties. Then on the other side, we have the $1.8 million option. We'll call this one the resilient band. Yeah, it costs more upfront, but it plugs you into a much deeper, much more diverse group of potential buyers down the line. So what kind of compromises are we usually talking about at that $1.4 million price point? Well, you're often looking at older resale properties, maybe 15, 20, even 25 years old. Or you're looking at really small, compact new launch units. A big trade-off is often location. You might be a bus ride away from the closest MRT. But the most crucial point here, the one to really remember, is that you're landing yourself in an incredibly crowded market. Now, let's contrast that with the $1.8 million property. That extra budget, it often unlocks better locations, maybe on the city fringe. You get larger, more family-friendly layouts, and you're much closer to an MRT and other amenities. But the real game changer is the type of buyer it attracts. You're not just competing for other HDB upgraders anymore. You're now on the radar for right-sizers, professionals, and some pretty savvy investors. The pool of potential buyers is just deeper. Okay, so we've seen what the money buys you, but what about the risks you might not be seeing with that cheaper option? This is where the whole idea starts to flip on its head and where this gets really, really important. We're going to break this down into 4 key risks. 4 things that, honestly, many buyers completely overlook because they're so focused on that initial purchase price. We're going to look at liquidity, something called the resale ceiling, rental support, and of course, those sneaky long-term maintenance costs. First up is liquidity, and that's just a fancy way of asking how easily can you sell your property without having to slash the price? Think about it. In that super crowded 1.3 to 1.5 million bracket, what happens when the market cools down? Suddenly, every seller is forced to undercut the next person just to get their listing seen. Your exit plan turns into a race to the bottom, and that is not a race you want to be in. Next, we have this fascinating idea called the resale ceiling. There's basically a psychological price cap on certain kinds of properties. You see, buyers who are looking for an older condo in an outer region, they just have a number in their head they won't go past. Let's say 1.6 million. This basically puts a hard limit on your potential profit, no matter how hot the overall market gets. Now, you might be thinking, I'm going to live there, I don't care about rent. But you should. Here's why. A strong rental market is what supports property values, especially during a downturn. Those cheaper condos, they often attract a very narrow group of tenants who are super price sensitive. This makes the rent unstable. The better located properties, though, they attract stable, professional tenants, and that provides a powerful safety net for the property's value. And finally, let's talk about the cost of age. That lower price tag on a 20-year-old condo can be a bit of a mirage. You have to start thinking about rising maintenance fees, the potential for big-ticket repairs, and just the simple fact that a new generation of buyers might not find an older place as exciting. The total cost of owning it can really creep up on you. Okay, so if the purchase price isn't the best way to measure safety, then what is? This is where we need to kind of flip the script and start looking at property investment through a totally different lens.
And this is it. This is the single most important idea I want you to take away today: demand depth. Real financial safety isn't about buying the cheapest thing you can find. It's about owning an asset that a wide, diverse group of people will always want to buy or rent from you, no matter if the market is up, down, or sideways. It's all about having options when you need them.
So that's the theory. But how does this whole demand depth idea actually perform when the rubber meets the road? Let's take a look at what typically happens during a market downturn. When we look at past market corrections right here in Singapore, a very clear pattern emerges. Those lower-priced mass market condos, the ones in that super competitive segment, they tend to see much sharper price drops percentage-wise. But the properties with deeper demand, like our $1.8 million example, they hold their value so much better. Why? Because people buy them for genuine long-term housing needs, not just as a speculative bet. And here's something else. Government regulations, like the higher stamped duties, actually make this effect even stronger. The market today is really driven by people buying homes to actually live in, not just to flip. And this massive shift gives a huge advantage to properties with strong fundamentals. Good location, good size, close to amenities. Basically, all the things that create that strong demand depth we've been talking about. So, to wrap it all up, what really makes for a safe property asset? It is not the price tag. It's about having a broad range of people who want to buy it. It's having solid rental support. It's not having 100 other identical units for sale right next door. And it's about being located where the city is planning to grow in the future. If you only remember one thing from all of this, let it be this right here. The whole conversation has to shift. It needs to go from what's the absolute cheapest thing I can get to where can I find the deepest and most resilient demand, because that is the true foundation of a safe property investment. And so I'll leave you with this final thought to chew on. We spend so much time focused on the entry point, on the buying price. But maybe the most critical question, the one that really determines your financial security for years to come, is all about the exit. Which property gives you the most options, the most buyers, and the most safety when it's finally time for you to move on? Thinking about that, well, it changes the entire game.